This episode is about who may be held liable for tax offences committed at a company. The issue will be explained by Dr. Jakub advocate and Senior Associate in Wardyński & Partners Criminal Law Practice. Jakub is an expert in white-collar crime, corporate criminal liability and compliance. After that, news about the Polish economy.
Benjamin Franklin once wrote that nothing can be said to be certain except death and taxes. Well, perversely, much about these two is otherwise. This includes one thing I would like to discuss: tax offences and the circle of persons who may be held criminally liable for them. Let's start by looking at the battlefield. By tax offences, I mean criminal tax offences and criminal tax petty offences specified in the Polish Criminal Fiscal Code. These range from the simple failure of a taxpayer or tax remitter to settle tax through to inaccurate bookkeeping, tax avoidance and tax fraud, all the way to complicated VAT carousel frauds. Now, the code states that such offences may be committed only by individuals and not corporate entities such as companies. So, if a particular provision penalizes a tax offence of a taxpayer or remitter that is a corporate entity, then there would be no person to prosecute and eventually held liable. For this reason, Article 9, Paragraph 3 was inserted at the start of the Code's operation. And this changed everything. Article 9, Paragraph 3 provides for extended criminal liability for tax offences. It states that a person handling the business, and especially financial affairs of an individual or a collective entity, whether under the law, a decision of an authority or an agreement, or by actually performing them, may be held criminally liable for any tax offence, just like a perpetrator. In practice, this vastly extends the group of people who may be held liable for tax offences committed at a company. This is because handling business has a broad meaning, particularly with respect to financial matters, which include a wide range of actions to do with tax settlements, including general tax services, bookkeeping or submitting tax declarations and tax statements. The question then arises, who is targeted by this liability? So far, the courts have found that persons holding the following positions may be held criminally liable for tax offences under extended liability: President of the Management Board, CFO, Management Board members, commercial proxies, chief accountants, financial directors, accountants handling the company's tax settlements, persons at external accounting firms providing tax services, or tax advisors. As you can see, this includes the vast majority of high-ranking managers and persons who deal with tax matters at the company. This may also include foreigners who do not even reside in Poland, but are generally obliged to run the company's business, even if taxes are not expressly included in their responsibilities. What is more, if such persons are found to have committed a criminal tax offence, this may entail the company's own criminal liability. And although rare in Poland, the vast majority of cases in which such liability is imposed involve tax offences, specifically a remitter's failure to pay collected tax to a tax authority. From this perspective, the key thing is to identify the boundaries for the liability and establish how to manage the risk. Speaking of boundaries, extended criminal fiscal liability may be attributed to persons having sufficient autonomy of action, as it applies to individuals who handle the company's affairs. This implies that such persons must enjoy certain independence and authority in deciding business or financial issues. The other limitation is culpability. In most cases, the prosecution must then prove that the persons charged with an offence wanted to commit it, or at least in anticipating such a possibility, accepted it. The latter is particularly important as far as tax offences at the company are concerned. It implies that the decision-maker's knowledge of a potential tax violation may entail criminal law consequences. Now that we know the limits, the question is how the risk of liability should be managed. As usual, prevention is key. You should ensure that you have a clear division of responsibilities for tax matters in the company. The company's internal regulations, such as those governing the management board and particular job descriptions, should make this clear and understandable. They should set out who is responsible for particular obligations under tax regulations and who supervises those processes. If you outsource tax matters to an external accounting firm, you should clearly define these issues in an agreement. The other important thing is to have a system in place in which any suspicions concerning tax settlements are detected and reported to responsible managers at the company. This may help fend off errors that could lead to violations of tax obligations and then turn into tax offences, something always best avoided.
When an individual in the US, Canada or UK wants to invest money in commercial real estate, office buildings, shopping centers, warehouses, hotels or private dormitories, they can do so through a real estate investment trust, REIT, by purchasing its units. REITs are investment vehicles that purchase commercial real estate in order to rent it out and pay their shareholders the profits generated by the rents paid by the tenants. Unfortunately, a Polish individual investor cannot do this as there are no Polish REITs for the time being. Therefore, Poles who want to invest in real estate simply buy flats in order to rent them out later, thus draining the market out of units that families are looking for their own residential purposes. The lack of domestic REITs is also one of the reasons that commercial real estate in Poland tends to be owned by Western investment funds, including Western REITs. And foreign capital accounts for more than 90% of the value of transactions in our commercial real estate market each year, which is a global exception. The Minister of Finance in the new government that we have had since last December has announced that work on Polish REITs will be resumed. And I hope that this time the relevant law will be passed because, firstly, national REITs would ensure a stable flow of capital into the Polish real estate market, protecting it from fluctuations such as in 2023, when Western investors invested only €2 billion in commercial real estate, 66% less than the year before. Secondly, the introduction of domestic REITs would provide an opportunity to redirect some of the money of individual investors from housing to commercial real estate. This could increase the availability of units for those who want to buy flats to meet their own housing needs and could put a brake on the rise in housing prices. Thank you for your attention. See you soon.